Good evening, everybody. Yeah, we came to market in October last year. Up until then, we were pretty much private equity owned, backed by Oaktree Capital Management, based out of Los Angeles. The company's actually been around about 140 years. Lanello Stock was a Croatian. He moved the business into part of Italy, which I think might have been Slovenia at the time, Trieste. And the business has grown from there. And when Oaktree moved into the business about 7 years ago, they bought the spirits business that was formerly Stock, and they bought Polmos Lublin in Poland. It had recently gone from a privatisation into a public company, and then Stock took it private, and Oaktree helped the whole merger of the business. So the main part of Stock Spirits, as we see it today, has been around about 7 years. Like most private equity owners, they need to exit after a period of time in order to make their returns. And we obviously did what we believe was a successful IPO on the London market on the as a premium listing last year. And as you just said, Hannah, we've gone from 235 the listing price, and I think today we closed at just 283 or something. So any of the investors that came at the time of the IPO have been pretty pleased so far. We believe it's just the start of the story. There's quite a full pack here. This is actually the pack we used on the IPO roadshow. I'm not going to go through all the slides. I'll try and pick up the main headlines, but happy to answer questions later. I'm the CFO of the company. Our CEO is actually on holiday in China at the moment, but our IR director is with me, and we're around afterwards for any more questions. I think the mission statement, it's actually pretty important. This actually means an awful lot to us. It's very simple, but it's very, very clear. We want to be the leading spirits business in Central and Eastern Europe. That's it. We're not trying to move into Brazil, we're not trying to move into Africa, we're not trying to move into any other sexy emerging markets. We just want to do Central and Eastern Europe. It has particular characteristics which are of interest. And I think the bottom statement, bringing global operational excellence to the region. And hopefully what you'll see from the presentation, we're a very experienced management team. We've all come from blue chip backgrounds. We've all got extensive experience of the drinks and spirits industry. And we bring something quite unique to the actual region. Most of the competitors we're up against in the region are local domestic players. Most of the alcohol drunk in the region is actually local domestic spirits. In fact, spirits consumption worldwide, 80% of all spirits worldwide is actually local domestic spirits, not the premium international brands that you may be familiar with, sort of Tanqueray or Kettle One or whatever. And what we tend to see is that our local domestic markets are small local businesses. 2 or 3 will tend to hold 60 to 70% market share. And what they tend to do is they probably got quite good at producing a brandy or a vodka, and then they suddenly thought, oh, there's an emerging trend over here in a different category, and they started to sell what they could make. And that's the classic difference, is they tend to sell what they can make in their factory. The factory may be completely underinvested. Most of these countries were former communist countries. Most of them were state-owned enterprises. And what you tend to see is that a lot of production investment stopped at the time of communism. There was very thin investment during the time of communism, and there's been very little effort since then to actually invest in production technology. So the production facilities are, let's just say, desperate at best in some instances. The product quality tends to be pretty inconsistent, which is pretty frustrating as a consumer, that you buy one bottle today and it tastes great, you buy the same bottle tomorrow and it doesn't taste great. But what they tend to do is they sell what they can produce. Our big core difference is we tend to produce what consumers want. So we actually take the trouble to find out what consumers want. So it's bringing this operational global excellence, working out what a consumer actually wants to consume, how they want to consume, and actually what they're willing to pay for that as well. And we have massively invested already in our production capability. If you went to our production factory down in Lublin, it's one of the largest production facilities in Western Europe, producing alcohol. It's got one of the fastest bottling lines in Europe. And we've put a huge investment there. We believe we are one of the lowest cost producers in the region. In actual fact, when we get visits, production people, I have to sort of say, tend to love going around everybody else's factories. And we get people from the big international firms who come around our factory expecting to see something that looks a bit third world, and often they're incredibly surprised. A classic evidence of whether you've got a good bottling facility is if you pick the bottle up and you feel the weight of it. If it's very lightweight, it means you have very, very smart technology which allows you to send bottles down a production line with very little gap between the bottles and actually fill them very quickly. If you've got very old technology, it'll be very heavy bottles. They'll be like a truncheon that you could use to kill a burglar. And that's because they can't send the bottles quickly down the production line. And if they sent lightweight bottles down their production line, the bottles would actually smash. Our ops director loves going into new businesses, picking at the bottles, and the big smile appears on his face because he can instantly take 70 to 80% of the cost just out of the bottle. And glass is an expensive item as part of our packaging. So one of the things we look at is how do we make a consistently high quality product at low cost, but actually it's what the consumers really want. So it's very, very different to the market that exists there today. And if you walk around a lot of our competitors, whether they be in Bulgaria or Romania, you will find very old, very underinvested facilities where they are making products or selling products that they can make, and not particularly bothered about whether a consumer really wants to drink them, really likes the price of them, really likes the consistency of them, or overall whether it's really working for them. Just in terms of a quick overview of who we are the largest spirits company in Central Eastern Europe, and the one that you've probably never heard of. If you go to Poland, we are in fact the largest spirits company in Poland. Effectively, Poland, it's a vodka market. 90% of all the spirits consumed in Poland is vodka. So if you're not big in vodka, then you don't really exist. There are other categories, and I'll cover those. Poland's actually the third largest vodka market in the world by value, behind the US and Russia, and it's the fourth largest in the world by volume. Ukraine squeezes in there. So it's absolutely huge, and vodka is the biggest category in spirits worldwide. And yet there's hardly any major players there. We are the biggest there. Pretty sizable. And we have very, very dominant market shares there. We have about a 37% market share, and our two major competitors there are local domestic players. We are also number one in the Czech Republic. The Czech Republic is renowned for its alcohol consumption, particularly of beer. They have the highest per capita consumption of beer in the world. They don't do too badly on spirits either. It's a bit more fragmented across various categories. Bitters, which we may not be familiar here in Western Europe, but if anyone has heard of Jägermeister, that's not our product, but it's a bitters type product. I have to say, most Czech men would regard Jägermeister as being a bit lightweight, a bit young and a bit sweet. And they like something a bit more macho and a bit more bitter than that. And that's the kind of bitters that we sell. And then there's rum. Traditional rum, which is made from sugarcane, as you would recognise it, but also the local Czech rum, which is called Tuzemski, and it's made from sugar beet. It tastes exactly the same, but it's not classified as proper rum. We're number one across all of those categories. We have some very dominant market shares. In rum, we've got nearly 70% market share. In Italy, we're certainly not number one. That is esteemed by Campari, but we're number one in many of the key categories, or number two. So we're number one in flavoured vodka. We've got a huge market share in flavoured vodka in Italy. Very old established brands. Clear vodka, we're number two. Limoncello, which many people probably taste when they go on holiday there and enjoy. We're number one, and we're number two in brandy. And those are some of the key categories and some of the key growth categories actually in Italy. It's a very different market to some of the other markets we operate in. And then in terms of other markets, we're quite a big business in Slovakia. We're the number one spirits importer, we're number one in bitters, and we're number two in fruit distillates. Fruit distillates is particularly unique to that central part of Europe, and it's basically alcohol distilled from fruit itself. There are some pretty bad copies of that, which is alcohol with fruit flavour added to it that pretends to be a fruit distillate, but we actually do genuine fruit distillates. And then we have an international business, very similar to Thornton's, I have to say, in terms of expanding our geographic presence in other markets, particularly in the Balkans. We have our own businesses in Bosnia and Croatia, and we have a very large enterprise in Slovenia, and then we sell into about another 40 other countries. Highlights are vodka or vodka products do make up roughly about 68% of our revenue, very big part of our business, but not to be disrespectful to the other categories, and in actual fact something like the bitters category is proportionally more profitable for us than some of the other categories. And revenues by geography, Poland is huge. It's about 60% of our total business currently, and our ambition is not to shrink Poland, but to grow Poland, but grow some of the other markets as well and grow our presence internationally. And I'll cover the numbers separately. I won't go through the summary of key highlights. Very quickly, we believe one of our competitive strengths is our management team. I won't go through all the names on here, But there's, I think when we run through this, there's 150 years of spirits industry experience on this page and about 300 years of FMCG experience on the page. One, it makes us a little bit older than average, but two, it generally means that we actually understand what we're doing a bit better. And a lot of the issues that we face, we've faced before. It's probably notable just to point out who Jack Keane is, our chairman on the top left there. Jack was one of the instigators of the founders of Diageo. He is a real doyen in the industry. Everybody knows Jack. He's absolutely fantastic. He adds a lot of value to the business, and I have to say he's a non-executive chairman, but he's very actively interested in the business, and is a source of great wisdom and inspiration for us. So a very high quality board, and obviously we've topped this now with a PLC board on top of it, with some very strong members from FMCG businesses. I think one of the things I want to talk about is what's been some of the key to our success to date. We have been a successful business, and it's really our approach, and it's this Western approach. It's not about selling what you can make in your factory. It's about working out what consumers do and then producing it at low cost, at the right price, and making profit out of it. We're very, very keen on making sure that what we do is profitable and that we're looking constantly to grow our EBITDA margin. And this is really what's taken our success so far, and there's more in the can on this. It's really about, when we bought the Polish business, what we bought was those brands on the left-hand side at the bottom. A couple of economy brands, one in clear vodka, one in flavoured, and then a couple of well-known flavoured ones. The one in the orange box, which you can't read and you probably can't pronounce, it's Jongowa. It's been around since the 1950s. It's a flavoured vodka. Flavoured vodkas are not modern trends. I have to say, in Central and Eastern Europe, they've been there for a long, long time. And Jongowa is a very well-established brand. It's as popular or as well-known as Jack Daniel's is in the States or Bailey's is here in the UK. And what we've done is we've taken these brands, we've basically invested in production capability. So from a production point of view, these are very now high quality, consistent liquids. And that's so key in this region because it's not common there for high quality consistency. We've lowered the cost of production significantly, one, by the efficiencies that we've taken through the factories, but also by the value engineering the products themselves. So the light weighting of the glass, sourcing alcohol from more than just a local supplier, and making sure the alcohol is of consistently high quality. It's being able to buy caps and labels from a global supplier rather than just buying from a local Polish supplier or local Czech supplier. So bringing all that global excellence and practice into here to actually ensure that what consumers are actually receiving and what they're paying for is consistently high quality, but for us it's also low cost. Now, one of the things we've worked on is, you've got to premiumise consumers and take them up from where they are, but they've got to be able to afford what you're doing. And it's been very much a case of looking at what consumers want and then working an MPD strategy into that to make sure that what we're actually developing satisfies consumers' needs at the price that they can afford, and it makes profit for us, which is most important. And really, this is a snapshot. That's about 6 months ago. We've had a very successful NPD strategy. As you can see, we've filled in an awful lot of the spaces here, but there's a lot of blank space at the premium and super premium level, and that's really where our next tranche of sort of activity is going to be, particularly in Poland, is really in that premium end where we know there's a huge amount of white space that's completely untapped. And I suppose one of the other things that makes us more unique as well, it's very unusual to go from making a flavoured vodka, Jongowa, and turning it into a clear vodka. Normally, most spirits companies will go from having a clear vodka brand into a flavoured vodka variant. And the clear vodka variant, which is the one you can see with a red flash in the mainstream area there on the left-hand side, is now the top-selling vodka brand in Poland. It is absolutely huge. It's more than a millionaire brand, which is selling more than a million 9-litre cases of product. It is absolutely huge, and we've done that in the space of about 3 or 4 years. So effectively, that's been the source for existing growth, and this is what we've done in Poland, this is what we've done in Czech, it's what we're currently doing in Slovakia, it's what we've done in Italy, and what we want to do is, one, continue our organic growth in terms of the development of the premiumisation and the white space that we still haven't got to, but then move this model into other markets. Just in terms of NPD, so I won't go through all of it, you can see the success of NPD. Roughly half of what we sell now wasn't there 6-7 years ago. And most of it's been in clear vodka, but you can see there's still an awful lot of white space in other product categories that we haven't yet tapped. The significant market leadership, I won't go through this, but the main thing is that most of our competitors are not big international players. It's not Diageo. In fact, the only market where Pernod or one of the big international players is there is primarily a little bit in Czech Republic in the bitters product and in Italy in clear vodka. Otherwise, nearly all of our competitors are local domestic players. Now, we have raised the bar. You know, they are having to start producing consistently high quality product. They're not there yet. Many of our competitors still haven't put the hard investment into production technology and capability. We know that they're getting better quality, but they still are not the lowest cost producer in the region, and that's going to be quite a long time for them to get there. But you can see our scale. You know, certainly in flavoured vodka, nearly 60% market share in Poland with 3.3 times the size of the nearest competitor. That's quite a big gap. We're not complacent about that. And we want to put more clear blue sky distance between ourselves and our competitors. And in Italy, we're 4.2 times the size of the nearest competitor in flavoured vodkas. I'll just cover a few. I'm going to really just cover Poland as one of the key markets because that's where most of our revenue comes from. The pack has got the details on the rest. A couple of things about Poland. One, it hasn't gone into recession. It has a fairly buoyant economy, and from 2014 it will be in receipt of 17 billion euros of funding from the European Union for infrastructure projects, railways, roads, airports, etc. And that generally means an improvement in employment and an employment particularly of construction workers, and it's construction workers that primarily drink a lot of our product. Big help. There's also a big privatisation programme taking place in Poland. They're moving away from a central controlled economy more to normal free market economies. There's a lot of inward investment coming into Poland at the moment. Consumer confidence is returning, and what you'll actually see across many of our markets, volume of product has been fairly flat or in marginal decline. I don't get particularly worried about that. You look at the UK and it's in almost free fall, to be honest. It's fairly flat, but what you will see is a growth in the value curve. So our future is not about volume growth. We will continue to take some market share, but it's about value growth, and it's about how you capture that value growth, which is about making sure that you can take price increases, but it's also about moving people up the curve from economy into mainstream, from mainstream into premium, and gradually premiumising the portfolio itself. That is success for the market overall to date. We don't see any slowing down of that, and that is very typical of more mature markets. The UK market is very typical of that. It's more value driven than volume driven. And when I say value, that doesn't mean economy, it means value accretive. In terms of an overview of the Polish spirits market, big market for beer, it's a big market for spirits. Wine barely exists. On all the occasions in the UK when you would sit and have a glass of wine, the Poles will sit and have a glass of vodka. They do have an exceptionally high consumption of vodka. They don't have social issues. You do not see people binge drinking. You don't see people drunk and rolling around on the streets. But they drink constantly throughout the day, constantly throughout the week. And it's some of the consuming behaviours are a little bit interesting, which I'll come on to. But as you can see, it's predominantly a vodka market. Whiskey is in there. It's less than 5%, and it's growing from a very small base. But it's predominantly vodka. The Poles drink vodka. In terms of market structure, I'm not sure if you're familiar for on-trade and off-trade. On-trade is where you consume alcohol on the premises, a pub or a bar or a restaurant. Off-trade is where you buy it in a shop and you take it home and consume it, or you buy it and take it into the street and consume it, which I'll say more on. The UK is proportional. It's probably slightly more off-trade than on-trade, but there's a lot of pubs and restaurants here in the UK. In Poland, it's predominantly an off-trade market, slightly unusual. Poles drink at home. They do not go out to drink. During the communist era, people just couldn't afford to do it. There were very few bars. They were only set up really for the higher echelons of the communist society. And that's pretty much the same. You will go to Warsaw, you will find bars and pubs, but they're predominantly for more wealthy business people or for tourists. Normal Poles will have friends over on a Friday night or a Saturday night, and the whole ethos about Poles is they take the top off the bottle and they throw it away, because there's never a half-drunk bottle of vodka in a Polish household. The route to market is mainly through traditional trade stores. It's not big supermarkets. Big supermarkets do exist there. Tesco does exist there, although it's getting a bit minced at the moment. There is an emerging growth of some of the discounters, a company called Beardronco, which is part of a Portuguese group called Jerónimo Martins. They're on a bit of a march there. But as you can see, as much as they've been doing their store openings, around about 70% of all alcohol bought in Poland is bought through traditional stores. And this is like a small newsagent. There's about 62,000 of them across Poland. And consumers will go in, they'll buy their cigarettes, they'll buy their newspaper, and they buy their vodka. And depending on what time of day it is, depends on what they actually buy. On the way to work in the morning, many of the construction workers will stop in and they'll buy a 100ml or a 200ml pack on their way to work, just as you might pick up a coffee from Starbucks. They just pick up a vodka from the store and they drink it on the way to work or sitting in the park whilst their dog has a walk around. At lunchtime, you'll find more construction workers going back in for another top-up before they go and use a bit more heavy machinery. Around about 3 or 4 in the afternoon, it's ladies normally collecting their children from school who just need something to keep them going for the evening. And then on the way home from work, it's businessmen who go and collect a half-litre bottle and then they will drink it shortly after they get home. And I know you're amused at that, but that is what happens, and we have acres of consumer research that continue to support this. It's a bit frightening at times. The most common unit of measure is a half litre, which is very small compared to a UK measure, which would be 70 centilitres or a litre. And the other packs that are very popular, the 200 and 100, like you get on an airline. Those are incredibly profitable for us, and they're very, very popular in Poland. For most of our competitors, they're incredibly expensive to produce, and they hate producing them. Diageo would hate producing them. We've got technology that they run down the line, and it's very cheap for us to produce. Just a couple of other developments in Poland. Slightly unusual, we're in a regulated industry. Regulation means licensing hours, advertising, etc. Poland is what's called a dark market. You cannot advertise strong alcohol in Poland. You can advertise beer, but you can't advertise strong alcohol. So spirits, there's no advertising permitted at all on TV, on billboards, in magazines. The only place you can advertise is in the point of sale, so in the store. And generally that's meant posters, shelf talkers, great big displays, floor displays. That's pretty much all you can do. But one of the things we've been doing, and again I'm based on market research and back to our innovation capability, is Poles drink vodka neat and they drink it chilled. They don't have a cocktail culture, they don't whack Coca-Cola in it or Red Bull or anything. They drink it neat, they drink it chilled. And one of the opportunities we were missing out on was providing consumers with chilled vodka at the point of sale, because we know from research they tend to buy it and consume it within hours. They don't go away and put it in a cupboard, they don't buy it in bulk, they buy it regularly, daily, hourly even, and they consume it very quickly thereafter. And one of the investments we've made in 2013, and it's just about finishing now, is we've installed 20,000 fridges in the traditional trade stores to actually provide our portfolio chilled for consumers. There's about 62,000 of these stores. 20,000 of these stores represents about 55% weighted volume distribution. So we've picked up the very, very best stores. It is not worth investing in these. You cannot make the financial return. I can't tell you what the numbers are that are coming out of this, but put it this way, it's making a very good return for us. We wouldn't be doing it otherwise, and we're seeing consumers trading up. I'm not going to run through all of these. Market share, we were at 16.5% in December 2008, we're at 37% now. We've taken market share off Pernod, we've taken market share off Brown-Forman, we've taken market share off our local domestic players. We've repeated this across our markets, I won't go through these. Just in terms of financial record, there's no way we would have got a listing on the premium market on the London FTSE unless we had got a performance record that was intact. Our EBITDA growth is exemplary. We've grown EBITDA every single year, and we've grown our margin. I'm pretty obsessed in making sure we grow our margin. And how can you make decent margins out of Central Eastern Europe selling local domestic spirits? Well, our EBITDA margin last year was higher than Remy Cointreau's. Remy is a big premium international business, and it's now in line with Campari's, and we see more headroom in terms of pushing that EBITDA growth up. Cash conversion. One of the things I'll say, the spirits industry is very cash generative. White spirits in particular, where you haven't got to lay them down for 5 or 6 years, is incredibly cash creative. And outside of big capex projects, which we don't particularly feel the need to do, our cash conversion is around about 80 to 85% of EBITDA. So very, very cash generative, and we do intend to pay a dividend from the half year this year. Just in terms of are there any other opportunities? We've got organic growth, we've proven our success and the model that we've adopted, and there's more space to go after. The blue is where we are. This is our definition of Central and Eastern Europe. It does not include Russia. Russia is too difficult, and you need to be Russian or connected to Russians, and we're not. So we're not going to go to Russia. The gold bit is what represents the future for us. There's 107 million 9-litre cases of product sold there. In 2012, we sold about 17 million litres of 9-litre cases, so big market opportunity. About 10 to 15% of that is premium international players like Diageo and Pernod. So there's still about 90 million 9-litre cases of product available to go after in those markets. In nearly all of those markets, 60 to 7% market share will be controlled by 2 or 3 domestic players. They are all domestic spirits. And they're all pretty much what we inherited when we moved into Poland. And what we want to do at the same time as developing our organic strategy and continuing more of the good work we've done is basically move into some of these new markets through acquisition and effectively repeat the whole thing again. We know many of these businesses. I have to say, since flotation, I'm getting an awful lot of these across the desk. Some investment banks' definition of Eastern Europe is interesting when you can see the Pacific from the windows. But, I'd probably call that Asia, but interesting. But there's a lot of opportunity there. But these transactions are not easy to bring to market. We're tending to deal with either family-owned businesses, and everyone knows families don't always get on, and particularly when it's second or third generation, there's probably even less commonality amongst the cores. Or entrepreneurs who probably started these businesses 10 or 15 years ago and they now want an exit. It takes a long time, and at the end of the day you need a willing buyer, a willing seller at a common price. And generally I would say we've got willing buyer, willing seller, but not a common price, and that's where we've been trying to work the gap on some of these. Some of these businesses are actually in administration. That's a real joy for us because it's easy to pick out. But you tend to find that these are ex-communist countries where when they went through a privatisation process, the government's either held onto a few shares, or as they've had to list on the stock exchange has still got some shares. So there's always some dimension of legal complexity along with these that we have to unravel. We've so far with the acquisitions we've made, we've fully protected the business in terms of warranties. We try very hard not to expose ourselves. And some of these countries, they're not all equal in terms of priority for us. Big vodka market is Ukraine, but you only have to open the newspapers every night at the moment to see that politically it's not the most stable of countries at the moment. Some have better corporate governance standards, some have more interesting FX challenges along the way. But there are plenty of opportunities there, and in the time that I've been with the business, we have constantly been looking at targets and opportunities. So that's where we also see part of the growth. It's not factored into the price at the moment, but that's where part of the growth will come from, the non-organic. Thank you.